Okay, this question. The management of this company examined the following company accounting records at some date immediately before the year end. Marketing service examined the following company accounting records at immediately before the year end. This company banking have a bank agreement with Canada Plus Bank required the company to keep current ratio, which is current asset divided by the current liability of 2.2 or better. How much in the current liability should this company pay within the next 2 days in order to comply with the borrowing agreement? So this is a classic example from the industry where the company have problem with the current ratio and they have to manipulate the current ratio in order to meet the bank requirements. In this case, they're not manipulating it, they're just using the simple technique. If the ratio is more than one, you just pay with the current assets, you pay current liability, you improve the current ratio. The question is how much we have to pay from the total current assets in order to achieve this. First thing first, we have to find out first how much is the current ratio at this moment, at August 29, how much is the current ratio? Current ratio is equal to how much? So how are we going to get the current ratio? Any suggestions? Everything that you know is going to be helpful right now. I would prefer if you can talk to me rather than sending me chats because it's very hard for me to share my screen and monitor the chat and doing the Excel spreadsheet. So ideas, how can I get the current ratio?
Current assets divided by current liabilities.
Current assets, that would be the simple thing, right? So in this case, do I know my current assets? My current assets, I know them. Do I know my current liabilities? I should know them too, right? And once I have those two numbers, what do we have to do? We have to calculate the current ratio to see where we are at this moment. Are we complying with the bank? Most likely not. Otherwise, there will be no question. So when we get the current assets divided by current liability, right now we are on 1.67. Can you see it? Now the bank wants the ratio to be 2.2 or higher. Anything higher than 2.2 is going to do it. Now we're going to the simple calculation. What should we do? How can I have here on this side, once I get this calculation, what will be my number here? What will be my number here? So once I get those two numbers, we have here 2.2. This is the question that I have to ask myself. So which will be the amount that I have to deduct from the current assets and deduct from the current liability, which gonna bring me to 2.2. Make sense?
Yeah.
That's where we are. How are we gonna calculate that one? Suggestions?
323,000 minus X divided by 193,000 minus X equals 2.2, and then solve for X.
Thank you so much. I cannot even say it better than this. So again, based on this, what we're gonna have 323, 123 minus X divided by 193, 123 minus X equal to 2.2. Solve it for X and move on. Is that how you did it, most of you?
Yes.
Yep.
Yes.
Okay, great. So then you should expect this one to come again. So see how well you understand this. Now, based on the information, that information obviously is going to change. That 2.2 is not going to be 2.2, is going to change to different ratio, but anyway, something like this. And then you can have it. So let's find something else. This one is straightforward. Thank you for your help on this question. So now let's try to find something else. Since this one doesn't give you that much challenge. Give me a second, I'm gonna find more questions for you. I have to do some formatting here, excuse me for a second. Because if I copy and paste directly, it doesn't give me the effect that I want. So this company is a new company which makes sales on account for 425. Can you see the question?
Yes.
$424,000. Now the company estimated that warranty repair at 4% of sales. The actual warranty payment was for $11,000. So what we need to do is we need to record the sales, warranty expenses, and how much we have to calculate is how much is the warranty at the end of the period. Any suggestions?
T-chart?
Yes. Any suggestions? How are we going to start? Obviously, the year end will be December 31st. So, first entry for the sales. We have to record the sales. That's the first thing that we have to do. Let's record the sales. And all the sales are on account. So which account we gonna debit here? Accounts receivables? I will appreciate if you just communicate with me rather than write me, because again, it's very hard for me to monitor everything at the same time. Accounts receivable, that will be for the 425,000, correct? So credit, what will be the credit here? Sales revenue. Now you have to be careful when you're using the Pearson because depends on the the choices that you may have, that will be different accounts and different names. So next one, we have to record the warranty expense. That's the second thing that we have to do. Warranty expense. December 31st till December 31st is our date here. What we're gonna have? Debit. Which account we're gonna debit now?
Warranty expense.
Warranty expense. Or warranty expense. Jennifer, your voice is really very bad. Okay, let's see. How much will be the warranty expense? How are we gonna calculate it? It will be 4% of the sales. Do we know the sales? We already know our sales are here. So what we have to do, we have to get that 4% and calculate the total expense. That will be equal to 425 times 4%, and that's gonna be $17,000 right there. Okay, once we have this one, what's the next thing that we have to do? We have
Record a
to
journal, credit warranty payable.
credit. What you're missing? Warranty payable. Give me something. Some
Estimated?
magic.
Estimated.
Estimated. Warranty. Payable. Why is estimated? Because it's not actual, right? It's not actual expense. It's estimated expense. Why are we doing this? To match the revenue with the actual expense, with the expense. And because that warranty is attached to the sales. If we don't have the sales, there'll be no warranty. So let's get that warranty, the same amount here. Okay, after that, well, the actual warranty payment was for $11,000. So how are we gonna do those payments? Still December 31st. Give me the DS, give me the journal entries here.
Debit estimated warranty payable, credit cash.
Debit estimated warranty payable, okay. And credit cash. Is there any other options for credit here? Can I have other options for credit?
No.
No? Are you sure? Is there any other way to set up the warranty claim? Customer comes to me, and let's say we're selling computers. What are the two options that you have to deal with the computers? You purchase the computer, you're going there, you're not happy, you want the warranty or something broke. What are the two options? First option is to get your cash back. Second option,
Get the inventory back.
to get the inventory back. So if this company, instead of set up the warranty payment, not with cash, but with the replace of the some item, whatever they purchase, what will be the account here? Which account we're gonna create?
Inventory.
Inventory. We have to get it from somewhere, right? So that's the other option. Either it's gonna be cash, either it's gonna be inventory. At this point, what we have to do? We have to do the account and see where we are. What we know, what we don't know. We know what kind of account is warranty liability, estimated warranty liability. What kind of account is that? Based on the statement that the account is sitting. Is it balance sheet account? Is it income statement account? Warranty payable? The payable account. That's the account that we're chasing. What kind of account is this? Help me here, please.
Balance sheet.
Balance sheet account. What kind of balance sheet? Where it belongs? Asset, liability, equity. Sorry? Liability. Okay. I think I got it. I hope that's what you're saying. Liability. Okay, it's liability. So since this is the first year, we're assuming this is the first time that they're operating. We're assuming the beginning balance is zero. Then we have the warranty expense, which gives the rise of the credit side of this account, and that will be our debit side. So the warranty expense triggered the estimated warranty liability of 17,000, and then we have that's a transaction on December 1st. Let's label transaction number. Insert here. That will be 1. Sorry, that will be, let's go with A. That will be B, and that will be C. Let's do it this way. So that will be transaction A here. Then we're going to have transaction B, which is the payment of the warranty, which is for the $11,000. That will be, sorry, that's not A, that's B here. That will be B, that will be C here, transaction number C. And the last thing that left is we to get the final balance, the ending balance for this account. Ending balance in this case will be
6,000.
$6,000. Credit plus the beginning balance plus the credit minus the debit's gonna give you $6,000. And we're done with this question. I don't think there's any challenge on this question. They should be very straightforward. I don't expect you to have any problems with that. Now, what else we can get here? I guess again, I told you that there will be questions on the GST. Let me see where is the GST question. Okay, I have something here. And let's start one after another on the GST question. Flip to Excel spreadsheet again. Can you guys see my screen?
Yes.
Okay, so now we're going with this question, which have the dates of the transactions and what actually happened. So this company purchased inventory on account, freight on board destination from this company for $3,200 plus applicable GST. So let's go one after another. May 09/8. That will be transaction number A. What we have here? Debit. What do we get?
Inventory,
Inventory. For how much?
3,200.
3,200. Okay, we got the inventory 3,200. So since we get the inventory, do we have to apply GST?
Yes.
Yes. Debit, that will be GST.
Recoverable.
GST recoverable. Why? Because we're gonna ask the government to pay us this one back. Let me put that GST. Where can I put it? So it can be easy for me to use it all the time. So GST equal to 5%. So that will be this one times 5%. So I'm done with the debit side. Credit side. Well, we're gonna go on credit side.
Accounts payable.
Accounts payable. Credit will be accounts payable. For how much will be my accounts payable? Obviously for the total debit, right? We have to be in balance. This one plus that one, and we get the credit. First transaction is done. Second transaction. Return defective material plus applicable GST. Let's return those one. We get it, we don't like it, let's give it back. B. What's gonna happen now? If I return them, what I don't have now?
Inventory.
Inventory.
Let's get rid of the inventory. Inventory. And how much I return? 480, right?
Yes.
Now, since the GST are not included, do I have to include the GST? What do you think?
You have to credit GST recoverable.
I have to create the GST recoverable, yes. Let's go and create the GST recoverable. Credit GST recoverable. How much? It will be simple calculation between this amount time that 5%, right?
Yeah.
So once I return those goods back to the vendor, do I have to pay for it?
No.
No. So what do I have to reduce now? I have to reduce my accounts
Okay.
payable. And my accounts payable is gonna go down with this amount plus that amount. 504. Okay, next transaction. What's happened next? On May 12th, we sold merchandising for 4,200 with applicable GST. Now the cost of those merchandises sold was 2,100. So how many transactions we have to do on the May 12th? C1 and that will be C2, right? We have to do 2 transactions. First transaction, let's show the sales. Debit. We don't know yet. Let's go with the credit. Let's show the sales first. Credit. Sales. Revenue. If you like it, so how much my sales revenue? 4,200. If I charge client for 4,200 for revenue, do I have to charge in the client GST?
Yes.
Yes. What will be that? Credit, GST,
Payable.
payable. And that will be this amount times 5%. So how much client has to pay me because it's on account, right? So I'm not collecting anything right now. It's all on account. So how much client has to pay me?
4,410
This amount plus that
and
amount,
210. Yep.
right? So now let's show the reduction of the inventory. Since I did myself, now I don't have the inventory. Let's reduce our inventory. That will be C2. Since I don't have the inventory, what I'm gonna have now?
Cost of goods sold.
Cost of goods sold. For how much will be that cost of goods sold?
2,100.
2,100. I get my cost of goods sold. So let's reduce the inventory. Credit inventory. And that will be the same amount, right? We have to be in balance. Okay, we're done with that. Next thing, let's collect the balance. On May 28th, it's a cash day. Client decide to pay. That will be D. Debit, your favorite account. Which is that?
Cash.
Cash, of course. What else? Cash. How much? 4,200 or something else?
4,410.
Yes, 4,410. Otherwise, I'm not paying the GST, right? If the client doesn't pay me the GST, I'm not paying GST either. So the credit will be
Account receivable.
accounts receivable. Since pay us, we're not gonna chase him again for that accounts receivable. Next thing, let's pay our vendor. Now for the vendor, how much we have to pay? Now we need to do some simple calculation here to see where we are on accounts payable, right? So this is my accounts payable, and that's my debit here, and that's my credit here. What I have first? I have $3,360 that I have to pay. Then I return $504. So how much I have to pay this person or this vendor? It's gonna be this one minus that one. This is the amount that we have to pay. Let's pay it. On May 30th, debit.
Accounts payable.
Accounts payable, let's close that accounts payable. Accounts payable for that amount. And credit will be the account that you don't want to credit, but you have to, cash. Okay, we're done with this. So what's the last thing that left? Prepare the remittance for the payments of GST. So what we have to do? We have to see where we are on those GST. So first, GST payable. How much we have to pay?
210.
210. GST recoverable. How much we have to recover first?
184.
Negative 160 first. And then we have another GST recoverable that will be positive 24. So in total, do we owe GST or we have to get the GST back?
Oh,
We owe the GST. So GST payable will be all this calculation. Correct? Now we know what we have to do. Now we have to balance those accounts. So basically we're gonna carry two accounts. I'm gonna carry here my accounts that will be the GST recoverable. And then I'm gonna carry another account that will be my GST payable. And my objective here is to close both accounts. In here I have 160, and then I have here 24. So my balance at this point is this one minus that one. I have sitting balance 136. Where in this account, what do I have? I have a credit balance of the only transactions that they did, and that's 210. So what do I have to do? Now you can see, first I have to credit GST recoverable for 136. I need something here. Then I have to debit my GST payable with something here. And the difference I have to pay it. Correct? Let's do the entry on June 15. Let's close the GST payable first. Debit. GST payable. That will be amount that we're gonna put here, which is exactly the same, 210. Then we're gonna get rid of the GST recoverable. Which is the equal to the amount that we have to put here, which will be exactly the same, 136. And the difference we have to pay,
Cash.
that will be credit cash. We got here to put a credit. Do you see anything scary on this question?
No.
No.
Okay. I hope you don't. Don't prove me otherwise, please. Okay, we're done with this. Let's move to the next one. The next question that I want we to go over was related to another liability, and that's accrual of the payroll. See if this gonna fit here on our sheet for our purposes. Yes. So this is something that we have, salary income. And that will be gonna come here. This one's gonna come here. Sorry about this, it's a raw stuff, so I have to deal with this right away. Total tax deductions will be, no, I don't want this one. It's gonna be those two together. Then I'm gonna have the CPP deduction. And then I'm gonna have the EI deduction. And then we're gonna get this total deduction. Total deduction for in our case will be those three numbers all together. And the net pay will be the net amount that has to be paid for the employee, will be equal to the total amount minus the total deductions. Okay. What do we have to do now? We have to do the journal entry. We have the information, now we have to do the journal entry. So that journal entry, let's pretend the date is June 30th, end of the month. Give me something. Which
Salary
account I'm gonna
expense.
debit?
Salary expense.
Salary expenses. How much? 1,970?
Yes.
All right. Okay, we got the salary expenses. Now, a question for you. At this point, do I know how much cash I have to pay to those people? right at this point, do I know how much cash I have to pay to those people?
Yes.
Absolutely. How much I have to pay them?
1,498.25.
That's it. So that will be credit my salary payable. Make sense? So one thing that you have to understand in this reality, once we're doing the questions here, and once you're doing the questions on the single chapter, like this chapter, for example, you understand this question comes from chapter 11, which deals with the liabilities. So if it deals with the liabilities, is it logical we to pay the payroll? Most likely not. Otherwise, it's not going to fulfill the purpose for the testing of liability. Make sense?
Makes sense.
So think about it on which chapter I am. What this chapter is about. This is about liability. That means everything I have to show the payables. Make sense? Otherwise, it's not a liability. So we got the salary payable. What else? Is there any other liability for the company because of this transaction? Obviously, we're not in balance. That's out of question. We are out of balance here. Is there any other liability that we have to pay?
There's CPP and EI payable.
And what else? Let's start with the main thing.
Tax.
Taxes. Credit, income, tax, payable. How much we have to pay for the income tax? That amount. Now the question is, from where are we gonna get this money? From where are we gonna get 336.92 in order to pay them to pay to the government? Do you see from where we're getting those money?
You mean cash?
No. Think about
No.
it. Think about it. I'm showing salary expenses from 1,970, but I'm paying cash or I have to pay my salary only 1,498.25. So from where I'm getting the income taxes to
When
pay
we
it to the
selling
government?
products to the customer?
Sorry?
When we selling products to the customer?
No. That's the revenue. No, here in this transaction, stay here. Stay in this transaction, only here
From employee salaries.
from an employee salaries. Do you understand this?
Yes.
Yeah.
If we don't have to pay the income taxes, which if you don't have to pay Canada pension plan, so we have to put here Canada pension plan payable, and then we have to put here credit employment insurance payable, correct? All those are liabilities. If I don't have those liabilities, how can I balance the entry? By giving everything to the employees. But Canada Revenue says, no. I know they earn 1,917, but you're not giving them those money. You're gonna give me something. And if there's anything left, then you're gonna give it to them. So, first, take out from the money that you're planning to give to your employee, take out the income taxes that they owe me. So, okay, so you say, okay, I'm deducting now 336.92, which I'm not giving to the employee, I'm giving to the government. Canada pension plan comes. By the way, for the money that you planning to give to your employee, take out 103 and 70 and give it to me. Then employment insurance comes. Are you planning to pay your employees? Yes, I'm planning to pay. How much you planning to pay them? 1,970. Now, from those 1,970, give me 3113. And the employee is gonna say, what's left for me? After you pay your taxes, your Canada pension plan, and employment insurance, you're gonna get $498.25. And that's the best you can get. Now I have to make transfer to the, first I have to pay the Canada revenue income taxes, pension plan I have to pay this amount, employment insurance I have to transfer this amount, and pay the employee that amount. Make sense? Now, the question is going to ask you to prepare the journal entry to record the accrual for the payroll from June 30th. Also, you have to show to record the related employer's liability as well. Let's say here you have this condition that you have to pay those one. So the next entry asks you to show me how much will be the deduction for the employer. What you're gonna say? On June 30th, how much the employer owes on this one. We're taking those one, all those things, we're taking it from the employee and giving the employee only that much. Now, is there anything for the employer? Does the employer have to pay income tax? On the
No, but the
payroll?
employer has,
No.
no, but the employer has to pay a CPP and EI.
So let's go with the CPP credit. Canada pension plan payable. That will be employer. How much he has to pay? What was the rule?
103.70.
Exactly the same, door to door, right? In this case, the employer pays door to door, 1-to-1 ratio. Next one, does the employer have to pay employment insurance?
Yes.
Yes, let's pay that employment insurance, payable, employer. How much he has to pay? What's the ratio here?
1.4 to 1.
1. So for every dollar, we're gonna pay, employer gonna pay 1.4. So how much do we pay? Employee pay that much. So how much I have to pay? Time 1.4. Okay, what's this for me?
Employee benefits expense.
Thank you. Benefit expense. And that will be equal to those two amounts. Make sense?
Yeah.
Okay, I want you to know this. At least you to know what you're paying and how much the employer owes. The other thing is, imagine this, employer make a contribution, employer make also contribution to your pension plan. Let's say on whatever he pays a pension plan. Pension plan. Let's say employer pays 3% of the gross amount. How are we going to do this entry?
Debit pension expense.
Debit pension expense. Credit.
Employee benefits. Expense.
Employee benefits. Employee benefits. I'm looking for something else. We on the liability chapter, people. What will be that?
Payable.
Yes. Employee benefit payable. Don't forget where we are. We are on in the liability, so that has to be payable. This one times 0.03. And we get the amount and we're done. Make sense?
Yeah.
All right. Let's find something else then. Let me find something else. Let's try this one. Let me move here. Paste this one here. I have to do some adjustments. Sorry. Just a second. Just give me a second. I'll be right with you. Probably you already sense where we're going with this one. So we have to you have to prepare single step income statement for the year ended December 31st, 2023. We have to forget about earnings per share, and income taxes are at 22%. That's what we have to do. Can you see the questions?
Yes.
Okay, let's go one after another. What do we have to prepare? Obviously, income statement. How are we going to start the income statement? You don't have to start. The good thing here is you don't have to start, but otherwise you have to start with the name of the company, name of the statement, and the period. Good thing is it's already done for you, so you don't have to worry about. At least you don't have to worry about those things, and that saves time. So that will be the starting point here. Let's put it here so we can start here. So the next thing, first thing, what's gonna come after? Then you're gonna have this subheading, which is gonna ask you to show me the revenue and the gains. And then you have to start with showing those one. What's the first? What's come first?
Sales revenue.
Sales revenue. What's the next one?
Interest revenue.
Interest revenue. Next one.
Gain on sale of vehicle.
Gain on sale. Anything else?
Those are sale.
We use this one. We use this one. And we use this one. Do you see anything else? Honestly, I don't see anything else.
No.
So there should be anything else. Shouldn't be anything else. Get this one first. That will be second one. Oops. And that will be the third one. Then you're gonna have to show me the total revenue and gain. Which gonna be very hard to get, but not impossible. That's not the number that we're looking for. We're looking that number here. 304, 1, 2, 3. And that's the number that we're looking here. So we have our calculation here. The first calculation, we have it. Next thing that's gonna come is the expenses and losses. Since it's a single, as you can see, you have to prepare a single step format. Not again, I'm not gonna chase you for the multiple step. Multiple steps gonna chase you next time when you start moving to the intermediate financial reporting, they're gonna chase you for that one. So let's go first one. Which one's gonna come first now?
Cost of goods sold.
Cost of goods sold. Second one. We use
Interest.
that. So let's use the different color. Which one?
Interest expense.
Let's go with operating expense first. Second.
Why is that?
Because that's the natural flow. It feels like a more natural,
Okay.
right? But
Okay.
the interest expense gonna come later. First gonna come the operating expenses, and at the end of the month or at the end of the period, it's gonna come the interest expense. Make sense?
Yep.
The other thing that the other way that you can choose those ones for the presentation purposes to start with the high number and slowly going down. That's another way to do it, right? But most likely here I'm chasing natural, how can I say, natural flow of the expenses. Operating expenses. Okay, we got the operating expenses. What else will be the last one? You said interest expense, right?
Yep.
Let's not disappoint you. Let's get this interest expense. And do you see anything else?
Loss on discontinued operations.
Loss on discontinued operation. So now let's think about it. Can we show the discontinued operation on the continued operation? Under the continued operation. Because we try to separate them. Continue operation with the discontinue operation. So usually we getting out of the discontinue operation, we show it separate. For what purpose? The users of financial statements want to see how much income company generating from the activity which is gonna continue next year and next year and next year. How much losing from the something that's not gonna happen again, that's not my concern. Or how much you're making for something is not gonna happen again, that's not much my concern as well. I'm chasing to see how much you're doing on the continuing basis. Make sense? That's why we're going to separate this one, the continuing operation and discontinued operation. So since we have cost of goods sold, operating expenses, what will be my last expense here, which we'll have to pay next year again and again and again? What do you think? Can you see it?
Income tax?
Income tax, yes. Now it's time for the company to pay income tax. Based on what they're gonna pay the income tax? Hmm? Based on the income, right?
Revenue?
So let's see how much is the income at this point. So let's get the cost of goods sold. Let's get the operating expenses. Let's get the expenses, interest expenses. And let's see here on one simple calculation where we are. This one minus this one minus this one minus that one. That's where we are at this point. You may not like it, but that's the only thing that we're gonna get. So on that, we have to calculate how much was the income, 22%. So let's get those 22%. This amount time 22%. No. And that will be our total expenses. Correct? Are you guys following me?
Yes.
Okay. So my total expenses here will be that much. Let's highlight it here. And that's my total expenses and losses. What's the next thing that's coming? Next thing coming is the income from continuing operation. We need to know that. And then we're going to see how much is the income from this continuing operation. This one minus that one is going to be income from continuing operation. And then we're going to get the calculation for the income from discontinued operation. After we eliminating the element, now we're going to put that discontinued operation. And then we're going to get, let me see what we're getting after. Just give me a second. Then the next item that we have is the loss from the discontinued operation. Let's continue here with the loss of discontinued operation. Which loss of the discontinued operation? Now we have to be careful because we want to show the lost to our users, but at the same time we want to deduct less the tax impact on that losses, because we don't want to show our users what's happening here. We want to deduct the tax implication from the losses. So now the tax, since we are losing money, so careful here. It seems like we don't owe taxes, correct? We're losing money. We're losing $8,000. Do I owe taxes? What would you say?
Yes.
So I'm losing $8,000. I lost. Do I owe taxes?
On the 8,000?
On loss?
No,
No. But can I save from the taxes?
I thought you could.
Yes, you can. So that's why it will be income tax saving. So the fact that you're losing, it doesn't mean that you cannot deduct the taxes from your loss.
Ah,
That's the beauty here, right? So now we're going to have income tax saving, which will be equal to the loss time the interest time the tax rate. That will be 8,000 times the tax rate, which is 22%. So you can save from your loss 8,000, 1,760. So how much will be your total loss after the income tax saving? What you say? What would you say?
9,000.
This one minus that one,
6,240.
6,240, which will be, in this case, that will be a negative amount. Make sense?
Yes.
But let's make it look like a negative amount here. Minus, and put this one in the brackets. And there we go. So how much is our net income? The net income in this case will be equal to income from continued operation plus loss from the discontinued operation, and that's how much will be our income. And we're done with this. Make sense?
Yeah.
Okay,
Yes.
awesome. That was another question. For you, you have to deal with it. Let's move to the next one. Just give me a second to put it in the format that can be easily readable. Let's move to the next one. Let me make it a little bit bigger so you can see it. Paste it here. So what we have to do here is we have to generalize the following transactions. Can you guys see the question?
Yes.
So we're gonna issue 18,000 common shares for that price. We're gonna purchase back 2,700 of those shares. And we're gonna repurchase we're gonna repurchase 2,200 shares for 26, with the average issue price was $22. So in this case, you don't have to pay attention for the first entry. You just have to do the first entry. Then you're not using the $23 anymore for the average issue price, since the average issue price is given to you. So let's go first one, February 07. There's our first transaction. What's going to happen here? Debit. We issue shares. What we get?
Cash.
How much cash we get?
18,000 times $23 per share.
18,000, 1, 2, 3 times dollar 23 per share. So we're gonna get 18,000 times $23. Is that how much you're getting?
Yeah.
Why we get those money? Because we issue
Issued common shares.
common shares. We get the cash, let's give them something. Because those people, when they give me $414,000, they want something. Let's give them shares. And we give them shares. Next one. What's happened next one? On April 08.
Debit common shares.
We're gonna get something, right? What we
Yeah.
getting? We're getting back our common shares. Right? What was the average price on our common shares that we're getting back? It's 2,700 times $22, right? So we're getting 2,700 times 22. We're getting 59,400 common shares back. That's the value of the common share, 2,700 at average price 22. What we giving? What we give to get those shares?
Cash for 2,700 times $20.
Okay, we pay them 2,007 for 2,700 shares. We pay $20 per share, right? How much we paid? 2,700 times 20. We paid $54,000. Now we're in trouble. Why are we in trouble? Our debit doesn't equal to credit. So we have to do something. What do we need, debit or credit?
Credit.
Credit. Let's go with the credit. Which account we gonna create?
Contribute surplus share repurchase.
Surplus common shares. How much? The difference, right? And we did. Next transaction. On June 02nd. That's transaction number 3. What did we get?
Common shares.
Let's get the common shares.
2,200 times 22.
200 times 22. Not 26, right?
Yeah, 22.
Okay. 2,200, 2,200 times 22. That's how much we get. That's what's the value of the common shares that we get back to us. Now, how much we give for those shares? Credit cash, right? We're giving cash. People always want cash. How much cash we give them? 2,200 for the 2,200 shares
Times 26.
times 26. So that will be equal to 2,200 times $26. We're again in trouble. What's our trouble?
Not in balance.
Not in balance. So we have more credit that we should. So we have to start debiting.
Debit contributed surplus.
Right.
Common
Debit
shares.
contributed surplus common shares. How much? We're gonna all wash out everything, right?
Yes.
Is that gonna be enough?
No, then we
No.
debit retained earnings.
So we have to balance it with the retained earnings. And how much will be that? That will be this amount minus this amount minus that amount. And now we're in balance, right?
Yeah.
Okay, excellent. Let's go another one. Okay, on January 13, this company purchased a store fixture for $67,000 cash, expecting furniture to remain in service for 10 years. Company has amortized the fixtures on DDP. What's that? When you see something like DDP, what will be that?
One divided by the useful life in years times 2.
Okay, but what will be DDP means?
Double decline balance.
Double decline balance. Now, how are we going to get that double decline balance? That will be the key here. Okay, let's do this double. On January 13, this company purchased store fixture for 67 cash, expecting the fixtures to remain in service for 10 years. This company has amortized the DB based on the estimated residual value $6,200. On September 30th, 2023, this company sold the fixtures for 19,500 cash because they were not environmental friendly. Record the amortization expense on the fixtures for the year end December 31st and 2023 and sell the fixtures September 30th, 2023. Let's go. What is the cost of the asset?
67,000.
Yep, that's too much. 67, 1, 2, 3. Okay. Let's make all those here 14. And let's get all those here like this. 67,000. Do we have residual value?
Yes, 6,200.
6,200. Okay. Negative 6,200. How much we have to amortize? Amortizable amount will be
60,800.
60,800. Okay. Is that matter for the double declining? Not really. What do we need for the double declining? For the double declining balance method, what do we need? We need the percentage, right? That's what's gonna save us, percentage. How are we gonna get that percentage? Number of the years, which is 10 years, and the percentage will be equal to 1 divided by number of the years. Correct?
Yes.
So what will be our percentage in this case? 1 divided by 10. It will be 10%. So for the double declining balance method, we're gonna use 10%. Okay, so apply for the first year. Year one. Year one. How much will be beginning balance? 67,000, correct?
Shouldn't it be 20%?
20%, oh yes, double declining, yes. You're correct, as usual. So, that's the percentage, the regular percentage, double balance, we have to do 2. So the double balance percentage in this case will be 10 times 2. Or, as you said, 20%. So let's do quickly our schedule. We need it only for the year one, right? We have a beginning balance. We have the amortization depreciation expense, which is based on the 20%. Based on the 20%, and then we're gonna have the accumulated depreciation, and then we're gonna have the ending balance. In year one, let's start with year one now. Beginning balance is 67,000. Depreciation expense is 67 times 20%. Accumulated depreciation is the same. Ending balance is 67,000 minus depreciation expense 53.6. So year two, since we're using it for year 2022 and 2023. Okay, that's our beginning balance in the second year, and then we're gonna have again 20% for the entire year. This one times 20%. Okay, so we have what we need. So let's do first one. We have to show the amortization first year. Can we show the amortization first year? Help, please.
$13,400 plus $10,720.
Okay. So what will be the journal entry here? Debit.
Debit amortization expense fixtures.
Fixtures. For amount of 13,400. Okay. Credit.
Credit accumulated depreciation fixtures for the same amount.
That will be same amount. Correct? That's year one, right? That's December 31st, 2022. Now, what's happened then? We have event on September 30th. What's happened on September 30th? We get rid of those. And we get 19,550 cash. What's the first thing that we have to do?
Debit cash.
No.
No.
What's the first thing that we have to do before we start getting the cash? Did we use the asset from January 1st to September?
Oh no. Oh,
Did we use the fixtures from January 1st, 2023 to September 30th, 2023?
we
Yeah.
used it for 9 months.
Right. So what we have to do, we get this amount here, that's for 12 months. Right? So now we're gonna get per month. How much will be per month for only for the second year? Will be this one divided by that one. And we're gonna apply it to how many months?
9 months.
9 months. So that will be give us this time that one. Okay, so let's do. What will be the journal entry here? Same. We have to repeat the same journal entry, right? What will be different? Depreciation expense. So if this is my depreciation and my depreciation only in year 3, in 2023, now this schedule is good, but we have to make some adjustments, right? So we're gonna leave this one, and we're gonna use this one only for that calculation here to get this amount. But for our purpose, for our calculation, we're gonna have beginning balance and amortization only for up to the point that we sold the assets. So what we're chasing how much is my accumulated depreciation up to this point. So now I have my accumulated depreciation. So now, what I want to do is I want you to see something. So watch this. Which accounts are involved here? I have 2 accounts. First account is fixtures, correct? And the fixtures is the asset account, which has normal balance debit. Once we purchase the fixtures, we have 67,000 sitting here in this account. But that account go together with another account, which account is accumulated depreciation, correct? Those two always go side by side. As long as we're gonna have fixtures which we're depreciating, as long as we're gonna have depreciation expense. So that will be accumulated depreciation fixtures. Make sense? Which also have debit and has credit. Actually, let's put it right below this account so you can see it better, like this. Let's extend this one and has credit. Now, what's interesting with the accumulated depreciation is since it's a contra account to the fixtures, it's going to have the opposite balance. So what we have so far for the accumulated depreciation? First, we have the depreciation for year one, which is equal to 13,400. And then we have for the year two, which is partial year, only to September, but we still have it. That's 8,400. So now what we're chasing is what's the balance here? The balance here right now is 21,400. 21,400, very much our schedule. So now on September 31st, on September 30th, that will be hard to do September 31st, somebody's going to give us a cash. Correct? Let's get the cash. Debit.
Debit cash.
Debit cash. How much? How much they give us? 19,150, right? That's how much we get. Why we get the cash? If we get the cash, what we don't have anymore?
Fixtures.
We don't have the fixtures. So can the fixtures stay with the balance? No, we have to get rid of these fixtures. How can I get rid of fixtures? By crediting the same amount. Make sense? So let's create these fixtures. Credit. Fixtures. This the fixtures balance becomes 0. So let's delete it here. If I create here 67, is my ending balance become 0?
Yes.
Yes. So I'm done with this. Fixtures gone. 67, 1, 2, 3, gone. Bye-bye fixtures. If the fixtures gone, can I keep the accumulated depreciation related to the fixtures? Can I keep this account?
No.
No. So what do I have to do? I have to get rid of this account. How can I get rid of account that has credit balance of 21,400?
Debit 21,440.
21,440. I have to debit this account with exactly the same amount, so get rid of it. So then we're going to have debit accumulated depreciation fixtures. And that will be for 21,440. Am I in balance?
No.
How much am I missing? I'm missing quite a lot, right? On which side? On debit side or credit side?
Debit side.
Debit side. If I'm missing on the debit side, what's that for me? That means I didn't get enough cash. So what will be that for me?
Accounts receivable.
Are they gonna pay me?
Okay.
It's
No,
loss on sale, isn't it?
it is loss on sale. We
Ooh.
already get the cash. They're not gonna come back and pay me another cash. Sorry, there's no accounts receivables here. So we didn't get enough cash, so what that means? We lost. So we're gonna have loss on sale of fixtures. How much we lost? Minus this one and minus that one. So we lost 26,410. What we're gonna do, where this loss gonna go? Where we gonna show this loss?
Income statement.
Income statement. And what we're gonna do with that loss? We're gonna reduce our net
Income
income.
tax.
Income tax in our net income. Make sense?
Yep.
So
Yeah.
did we actually lose this money? If it's in the hands of the individual, yes, you lost it. But it's in the hands in the company, not yet. You're going because why? Because you're gonna reduce your income. So you still have some benefits of having loss. Okay, that's with this question. Question on this question.
Nope.
So let's change the scenario here. Let's make it more interesting. So we still have the same thing, but so you see, if my accumulated amortization, let's play with the numbers here. Can you see the numbers? In this side, only this thing. Let's play a little bit and let's think about it. Can you guys see it?
Yes.
Okay.
Yes.
If we don't get a loss, what's the other option?
Gain.
Gain. Let's put that gain. Gain on what? On sale of fixtures. Make sense? Are you guys with me?
Yeah.
All right. So let's think about it. If we sell whatever we sell, whatever asset we sell, we don't have the asset. Correct? Once the asset is gone, what else is gone? Any accumulated depreciation related to that asset. So we have to get rid of that right away. There's no questions about it. This amount is gone. So now, at this point, we already know where the difference is. Make sense? We know that we pay for something $67,000. We use it and we deduct it out of $67,000. We deduct $21,400 for the usage, deducted as an expense. So how much left to deduct? 45,560. At this point, the question is, if I sell it, how much I'm gonna get? If I get more than this amount, I'm gonna have gain. If I get less than this amount, I'm gonna have loss. What I'm losing? I'm losing opportunity to use the asset and transfer the cost of the asset as an expense. But do I actually losing that opportunity? No. Why? Because I'm deducting that loss from my income anyway. Make sense? Do you understand the whole game here that we have? I want you to understand this game. I want you to see it through. So next time, every time when you see a question like this, don't to get scared and don't to worry about it. Do you understand what we're doing here?
Yeah.
So imagine if I amortize this asset completely, how much will be my accumulated depreciation? The same amount as asset, right? So that means through the life of the asset, I amortize the entire amount. What is my difference? There's no difference. I use the asset, I deduct all the entire amount from my asset, I deduct it from my expenses for my income as an expense. Make sense? So the question is, if I sell it before I completely use it, what will be my consequences? And that's why we're having this question now when we have 21,440 amortization accumulated at this point, where will be the cash? Obviously, if I get more than 45, let's say if we get $50,000 cash, what we're gonna have? We're gonna have gain. How much will be my gain? That will be this one plus this one minus that one. That's my gain. But if I get less than that, if I get, let's say, 40,000, then I'm gonna have loss. Make sense?
Makes sense.
Makes sense.
So what else can reduce my loss if I have more accumulated depreciation at this point? If I use the asset longer than 1 year or 2 years, then my accumulated depreciation will be higher. And based on what I'm getting, either I'm gonna have gain, either I'm gonna have loss. But the bottom line is, once I sell the asset, I don't have the asset anymore. Get rid of the asset. You cannot keep the accumulated depreciation. Get rid of it. See how much cash you get, 20,000, 30,000, whatever you get, and then solve it for the either on the debit, either credit side, and you're done. Leave the gain and loss as a last calculation. Get the cash first, get rid of the asset right away, write off the accumulated depreciation, see where you are. Balance the entry, move on. Okay, let's keep going with these questions. Let's see what else we can get. Just give me a second. Find some more questions interesting. Okay, I found one question. Just a second, I'm gonna show it to you. Just give me a second. Since we are on the amortization and depreciation questions, let's stay on that side. Can you guys see my screen?
Yes.
Okay, this company purchased and use a Bombardier aircraft cost of 45 million, should be million, right? Bombardier should be a little bit more expensive. The company, let's keep computer secondary amortization. Company expect the plane to remain useful for 6 years. Or 6 million miles and have residual value of 5 million $750,000. Now also this company expect the plane to be flown for 650,000 miles in the first year, 550,000 miles in the second year. So now what we have to calculate what will be the depreciation for this asset for year 2 under each of the methods. Which are the methods? Obviously the usual suspects. Straight line units of production and double declining. Let's start with the first thing that we did last time. What's the first thing that we need? We need cost of the asset. What's our cost of the asset in this case? It's quite a big, isn't it?
45 million.
Okay, 45 minutes. We get the cost. Do we have residual value?
Yes.
Let's deduct the residual value, which is in this case is 5,750,123. How much we have to amortize? How much you getting? Do you getting what I'm getting?
Yes.
Over how many years?
6
6.
years.
6 years. Or miles?
6 million.
Miles. I believe that's the million. And the percentage will be? Because for double declining, we're gonna need that percentage. 1 divided by how many years?
6.
Divided by 6 years. Our percentage will be that much. 17%, but let's make it 16.67. So let's go with the straight line method. Straight line method. Do I know my depreciation per year?
It is the amortizable amount divided by the useful life in years.
Is that how much you're getting? So if I do this, how many years I have to do it? 1, 2, 6 years, right? If I do this amount 6 years, I have to get the amortizer or depreciable amount. Let's move it to the depreciable amount. Since we're working with the depreciation. So if the question asks you to compute the amortization for the second year, do you have amortization second year using straight line method? Can you guys hear me?
Yes.
Okay. So that's a straight line method. What's the next method? Unit of production. For the unit of production, since I'm gonna use this machine for 6,000 miles, do I know my cost per unit? Or depreciation per unit? Depreciation per unit.
Is the amortizable amount divided by
6
useful
million.
life in miles?
So it's gonna be that much, right? 654. So do I know how much I use this machine in year one? In year one, I use it 850,000 miles. Year two, I use it for 550,000 miles. Can I get depreciation for any of those 2 years? So how much would be the year two here? And what's the last method that left?
Double declining balance.
Double declining balance. For the double declining balance, what can we do with double declining balance? Let's get from here, move it to right here. For the double declining balance, we have to use it too, right? So
Yeah.
what will be the percentage now?
16.67 times 2.
2 times 16.67%. And it's gonna be 33.33%. So year one, year two. How much will be my depreciation in year one? What will be my starting point now?
45 million.
That will be 45 million. So year one, year two. That will be my starting point. Beginning balance will be 45, 1, 2, 3, 1, 2, 3. Then I'm gonna apply this amortization time this one. And then I'm gonna see how much my ending balance. How much my ending balance?
30
This
million.
one minus that one. And the next year, how much will be my depreciation?
10 million.
10 million. Not this one. This one should be like that. Actually, let's do it. So, if you have to do this question, the first year, that will be a number. Second year, that will be a number. And the third year, that will be a number. Which one is going to give you the highest depreciation? Obviously, double declining. You can see it now. Which one is going to give you the lowest depreciation? Units of production. Questions with this question?
No questions.
No questions? Let's do one for the payables, not payable. I believe last time we did something on the not payable, but let's do one more not payable. Can you guys see my screen?
Yes.
Awesome. So purchase delivery truck. So on May 1st, they purchased delivery truck for that amount with issuing 1 year, 6% not payable. December 31st, we have to accrue the interest. So we have May, we have December, and we have May. So let's go one after another. May 1st, which is our first entry. What we gonna do? Let's get the truck. What we get? Debit.
Delivery truck.
Delivery truck. What's the cost that we have to depreciate?
104,000.
104, 123. Okay, we get that one. Did we pay for the truck?
Note payable.
Absolutely not. We give them not payable. Credit not payable. So what that means, on which chapter we are once you see not payable?
Liability.
Exactly. So what is expected from you to show that you know about the liabilities? Simple. So what will be the next one? You have to show the liability. When? On December 31st. What's happened on December 31st? Technically nothing happened, right? There's no event here. But we have a reporting date. What we have to show the reporting date? Any outstanding liability. That's why on the reporting date, we're thinking, is there anything that I did in the past for which today I owe money in the future? Well, obviously, we get the truck. Did we pay for the truck? No, we didn't. Do we owe interest? Yes, we do. For how many months?
8 months.
8 months. How much is the annual amount that we're owing now? If we have to pay for 1 year, we have 104,000, which pays interest is 6%. So for the entire year, we have to pay $6,240, right? But how much is that per month? This one divided by
12.
12. So $520 per month. So on December 31st, how many months we have? May, June, July, August, September, October, November, December.
8.
8. So we have to show the interest for 8 months. For which we use the not payable. Debit.
Interest expense.
Interest expense. Let's reduce our income. Interest for 8 months. And that's gonna be this amount times 8.
4,160.
Credit.
Interest payable.
Interest payable. Why? Because we're in the liability chapter. Because we use the not payable and we owe the interest since it's the reporting date. Now, let's do the one more entry on May 01st. What we're gonna do first?
Debit the note payable.
Debit the not payable. Okay. Debit not payable. Let's get rid of the not payable. We're gonna pay it in total, right? How much is that? 104. Okay, what else we have to get rid of? Let's get rid of the next liability. What's the next liability?
Interest payable.
Debit, interest, payable. 160. Is that the entire interest that we owe?
No.
No. How much more we owe? Interest for how many months?
4
4?
months.
4 months. We have to complete the year, right? Debit, interest,
Expense.
expense. For 4 months. This one times 4. And what's left? We have to give them something.
Cash.
Credit, cash. How much cash we gonna give them? Well, everything related to those numbers, right? This one plus this one plus that one. So, how much we pay them? The principal plus the interest. Make sense? Do you see there's 3 amounts here? Are exactly those 2 amounts here. Now, this amount, on the other hand, if I can flip it here, this amount, on the other hand, is split by 2 amounts. Which are the 2 amounts? One expense here and another expense here. Can you see it?
Yes.
Those two, they're killing each other, aren't they? That payable kills this payable. This payable kills this payable. The only thing that we have to pay is the interest. That's the extra thing for us. Otherwise, everything else is just killing each other. This payable, and everything comes get out of the cash. If we pay cash the first place, there will be no payables, there will be no interest, there will be nothing. Life will be so simple. Okay, that's this question. Let's see if I can see anything else. Yes, the last thing left is the balance sheet. That will be the last thing. Let's do some modification here. Luckily, the numbers are not so bad. Looking good. Okay. Can you guys see the information?
Yes.
Let's make it bigger so you can even see it better. Maybe I should get rid of this. Let's make it this way. Okay, so what we have to do, we have to prepare company classified balance sheet for the year for December 31st. That's what we have to do. How are we going to do this? We're going to start one after another. First, we're going to start with the general thing. Company, name, balance sheet, and period. Good thing again, you don't have to do this. It's going to be given to you, so you don't have to worry about it. Then we're going to have to, is going to be given to you assets, and the next thing you have to do is the current assets. And we're going to start one after another. Current assets, which assets we're going to start? What's the order here for the assets? How are we going to show our assets? Give me some ideas. If you have to show the assets, how are you going to show them?
Start with cash.
So what's the general rule here? We're listing the assets based on
Liquidity.
liquidity. How fast we can spend them. Which one is the one that you can spend right away? Cash. So let's start with that cash. We get the cash, right? Next one. Cash gone. Next one.
Inventory,
Which one is faster? Accounts receivables or inventory?
Accounts receivable.
Accounts receivables. Let's get the accounts receivables. Then will be inventory. So what else we have? Do we have anything else left for the current assets? So accrue liability, that's a liability, right? Long-term not payable, liability. Property, plant, equipment, asset long-term. Prepaid expense. What's that?
it's an asset.
It's an asset. Let's put it in the asset where it belongs to. Prepaid expense. Patent, long-term assets. Accounts payable, liability. Interest expense. Where on the balance sheet I can find interest expense? Any suggestions? Where on the balance sheet I can find this interest expense? What's interest expense? Is it asset? Is it liability? Is it equity? Come on, people. I know it's late of the day. But tell me, where can I find on the balance sheet interest expense?
Liability?
Interest expense.
Equity,
Interest expense.
Asset.
Interest expense, people. Where can I find it?
expenses,
In expenses.
Oh,
It is not
income
on the balance sheet.
statement.
Is it on the balance sheet?
no,
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 Income
absolutely
statement.
not.
It goes on the income statement.
Exactly. Why is here?
to confuse us.
To catch the people who don't know what to do with it. Make sense? Pay attention, please. There always will be something which is out of ordinary, which has nothing to do with what you have to do. But since you're under pressure, since you're on the clock, and since all the emotions about the exam, when you see interest expense, you're not thinking, and you say, "Oh, I should do something about it." Maybe, but we'll see later. So next one, dividend payable. That's liability. total assets, we have the total assets, net income, shareholders' equity, equity December 31st. We have all those things, common shares, preferred shares. Okay, let's keep going here. So is there anything else left on the current assets? Or we catch everything? I think we catch everything. Let's get the amounts. 39,000. This one, accounts receivables is that much. Inventory, that much. And prepaid expenses is that much. So total current assets. Total current assets gonna be all those four together. And let's present it properly. This one's gonna disappear from here. It's gonna come here. Boom. First line is done. We have our total current assets. Let's keep going now. What's next? Next thing will be
Long-term assets.
long-term assets. What's the long-term assets? We have only one, right? That will be the next one. And that's, since it's the only one, it's go directly to the total calculation here. And the next thing that we're gonna left here will be, you're gonna be asked to do something like this, which will be intangible assets. And that intangible assets, we have only one option, patent net, right? And that's gonna go directly right here as well. And then you're gonna have total assets. Total assets, let's make it presentable. And my total assets in this case are all those four together. Get the total line and finish the asset section. And we're done, right? So now if you want to make it more presentable, we can do some tricks here and there. And we're done. That's our asset section. Now we have to deal with liability section. Good thing is you don't have to do those things. Everything is done for you. You just have to follow the format and choose the right things. And then we have current liabilities, obviously. Current liabilities, and let's start dealing with the current liabilities now. So we cleared this one, that's part of assets, that part of the assets. Now let's go with the liabilities. Which one are we gonna start? Again, most liquid. Which one we have to pay right away?
Accounts payable.
Accounts payable. Let's deal with accounts payable first. Accounts payable. Next one. We have the accrual liability. We have dividend payable. And that's about it, I believe. Do we have any information? Let me check if they prepared. No, that's about it. So let's go with the dividend payable next thing because we don't want to annoy those shareholders. And the last thing that we're gonna do is the accrual liabilities. Those are the three payables that current liabilities that we're gonna show. Correct? Are you guys with me?
Yes.
Yes.
Okay. We get this one, we get this one. Let's get the amounts. Accounts payable was 44,000. The dividend payable were 4,900 and accrued liability 22,000, total of that much, and we're gonna change this total here, move it here. And that's gonna show us our total current liabilities. Next thing, what we're gonna have?
Long-term.
Long-term liability. What will be our long-term liability? There only one liability long-term, right? That will be long-term, this not payable. Which will be exactly gonna come here. So long-term, so we get our total liabilities. Correct? Total liabilities, that much. What's next? The equity section, right? Shareholders' equity, and then we're gonna have contributed capital. For the contributed capital, we have to somehow fit all these descriptions. Contributed capital, and we're gonna have those common shares, blah 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 blah. Here, and authorized, and then we're gonna have no, actually, is it common shares or preferred shares? Which is gonna come first? What do you think?
Preferred shares.
Preferred shares. Let's go with the preferred shares. I like preferred shares first too. Yes. Let's go with the preferred shares, and let's get the issued and outstanding, and those are issued and outstanding, and the total amount of those preferred shares will be of that much. Then we have to deal with the common shares. Again, you don't have to do all those things. Everything will be pre-set up for you. So you just have to fill the gaps and you're done. You're done. Authorized, and then we're gonna have common shares which are issued and outstanding. And we're gonna have this amount, yeah, that much. So once we get those two, what's the next thing that we have to do? We got those two. Those are done. What else we have to play with? What's left for us? Interest expense we said without. Total assets, that's not net income, we don't care. Total shareholders equity per last year, we don't care at this point. All this information, we don't need it. Let's highlight it in this, we don't need it. What's the last thing that left? And this one, we don't need it. Retained earnings, right? That's the last thing that left. Isn't it?
Yes.
Yes. How are we gonna get the retained earnings? Who's gonna tell me how we gonna get the retained earnings?
Current assets minus liabilities minus
Exactly.
equity.
Exactly. Just balance it, right? That would be the easiest way. Right. We don't have enough information to come with the net income minus the dividend payable. Or maybe that might be a something. Let's check if we get this amount minus the dividend payable, we're gonna get this amount. Now, if we plug this amount, is that gonna solve our problem? That's where we are. So let's go here. Now we need here the retained earnings, right? Now we don't know how much is the retained earnings. And then once we solve that retained earnings, we're gonna have the total shareholders equity, right? Make sense?
Yes.
Now before that, we can plug here one line. That's gonna say, before we go to the retained earnings, we can plug here one line to say total contributed capital, total, which will be those two. And then we're gonna get the retained earnings, which will be this one here. Now the retained earnings, we're gonna be questionable. Which one is it? Which exactly is? But we're gonna figure out. Let's leave it for now. And the last one left is the total shareholders equity, which will be coming from here, this one, and the last line left for the total liability and shareholders equity, which will be right here. Not this way. Let's go this way. And we'll be done. Now let's balance this one. So now we know this should be equal to that one, right? We already know that. Those two should be matching. So if those two matching, our total shareholders equity should be this one minus that one, correct? Now the only way those two to match is if our retained earnings is equal to this one minus that one. 346, 100, no, that's not the same. So that's how you're gonna balance it. Make sense? So you're gonna go backwards to get the retained earnings. Questions? Any questions, people?
No.
All right then. If all the Excels are gonna be available on the Blackboard, what do you think?
Yes.
Is that a question? It sounds like a question, not like a statement.
Please post it.
Please, Paul.
Could you please post the Excel
That
spreadsheet on Blackboard?
that sounds like an hour requirement. Okay. Now that's already taken. That's Q4. That's Q5. The only thing that I'm afraid, if I do that, basically I'm giving you the questions. You understand that, right?
They won't be exactly the same.
No, they're not. You're right.
And plus, you've already recorded this, so you know.
I know. I know. I'm just saying. For the recording, you know? So this one changes, right? So let's fix this one. Where is this one? This one plus that one. Oh, okay. Okay, so you're saying this one. So that will be all with the questions. Let me see. So technically, I'm not gonna pose these questions, but you have access to it, to the recordings, and that will be all for today. So let's repeat this one for the multiple choice questions. Please pay attention on the earnings per share, more specifically how you're getting the denominator. Nominator will be income, how you get the denominator, which will be the weighted average number of shares. Also, I want you to pay attention on what was that? How to calculate the retained earnings. You already know how to calculate the retained earnings. If you have a dividend, that dividend has to be distributed to the preferred shares and common shares. Which one gets first? If it's cumulative, how much the preferred shares get, and what's left for the common shares. Pay attention to those things. Don't stress out during the test. Try to relax, read the questions. Those are not questions for, how can I say, for some people with the extraordinary abilities. Those questions are for you. Every time when I look at the question, my only question that I ask myself is, can you guys do it? So I'm not going to give you a question that you cannot do. Keep that in mind. So if you see something that seems like hard, think again, read it again, slowly solve it. Remember, get the easy part first, then think about the hard part. The other thing, don't give up. Don't leave question unattended. This is the worst thing that you can do. Just see something, oh, I don't know anything, and just move on. Try it. Try it. Because if you don't try it, then you make my life easy, my life difficult after. Even if I want to give you something, there's nothing to give you because you didn't do anything. Keep those things in mind, please. And you'll be fine. Questions? Yes, I wanted to tell you about the ratios. Ratios, if you see on this question on the balance sheet, there's one ratio that you have to calculate. I believe the ratio is not that difficult. You have to calculate ratio. I'll tell you right away. What was the ratio that you have to calculate here? Return on the asset. Return on the asset. So that should be very straightforward. That's why in this, the last question is given the assets from the previous year and the current year. So you can have the average of the assets. For the return assets, you need the average of the assets. Questions?